Shares in the Commonwealth Bank have surged more than 4% today to a five-year high after it posted a half-year cash profit of nearly $4.5 billion. While it's down more than 4%, it's much better than what the market had anticipated.
Really, as the interest earned from business lending, mortgages and transaction accounts rose, offsetting that $83 million bushfire claim impact. The bank also maintained their half-year dividend of $2 as expected, and the market liked hearing that.
And CommBank shares closed at 88.18, outperforming the rest of its major peers. And for more, I spoke with CommBank CEO Matt Comyn a short time ago and first asked him, a year on from the Banking Royal Commission, what's changed at the bank?
Well, a number of things have changed. We've put huge investments into our management of non-financial risk in particular, a huge commitment towards delivering better customer outcomes. That was one of the things that we called out in the result today. One of the reasons why our result was down 4% year on year is because we made a number of fee and pricing changes over the course of the last 12 months that delivered $415 million of better value to our customers and less revenue to the Commonwealth Bank.
Matt, last week the Reserve Bank said that loyal bank customers are paying higher mortgage rates than new customers. Is that fair?
No, I don't think so. I mean, today as part of the results briefing, we did talk a lot about some additional disclosure we provided, the pricing differences between customers that are getting very strong offers in the market today and how that may have compared in the past. There's no escaping the fact that home lending is very competitive. It's a lower credit growth environment. Many financial institutions are offering very sharp pricing to try and win over new customers. And of course, it's a fair issue to call out, and it should be incumbent on institutions such as us to make sure that all customers are getting a fair and appropriate deal.
Now, we've heard from some ratings agencies saying that the coronavirus is credit negative for the banks. Just how concerned are you about the outbreak?
Well, we've certainly been watching it closely. We have some operations in both Shanghai and Beijing and different parts of Asia and Hong Kong and Singapore where clearly there's been more of an interruption, as much for the safety and well-being of our people. As we've looked more broadly, exposure to industries like tourism, education. There's a lot of foreign students that come into the Australian economy and market. We've looked at some of the corporates that maybe have supply chains that are interrupted. Overall, we don't think it's going to have a particularly significant impact, but we do think it's